Good morning and welcome to Bazaar Morning Call. I am Anuj, with me Prashant and Sonia. We of course start the week with the sad news of yesterday when Cyrus Mistry was killed in a road accident at a fairly young age. So pretty sort of sad way to start the week with.
And absolutely tragic, right? Shocking, unbelievable. I mean, I heard the news and I said, you just don't think that something like this could happen. Extremely.
It's unfortunate, right? That's the only way to put it. Yeah. And also, of course, condolences to Cyrus Mistry's entire family and friends. But just spare a thought also for the other passengers in the car. Renowned gynecologist Anaita Pandole and her husband Darius Pandole were in the front seat. Luckily, they were belted. And, it speaks a lot about the car safety, road safety as well, right? I mean, Anuj, when was the last time you wore a seat belt when you were sitting in the rear seat? So I think there are too many things that just put together and made this a really unfortunate incident. And we hope that Anaita and her husband recover because they are critical at the moment. Yeah. But Jahangir Pandole and Cyrus Mistry were killed.
Yes, so sad news, of course. To wake up to, I mean, as Prashant said, for half an hour or so, you didn't want to believe, that it happened. But then, that's life. It can be like this. But now let's talk about the market, and we are starting, of course, a brand new week. And what's important and interesting is what happened to the US market on Friday, because for the first hour after the jobs data, we were all watching out for the jobs data. The Dow was up 340 points. It ended down 340 points. But what was spoken about when, at least, at that time I was awake, is that it was Goldilocks, the US jobs data, almost the best case scenario for the equities, which is the jobs gains are there, but the wage rate is slowing down, which perhaps means that while the 75 basis point rate hike may still happen, pace of rate hikes might be slower. And that is exactly what you describe as Goldilocks scenario for the equities. However, must point out that dollar index is still stubbornly close to 110. There it is. And Brent crude is at 95. So lots of moving pieces. Let's see which way things move. SGX Nifty is indicating that we'll have a flat start with a downward bias, and then we'll take it from there.
Okay, and of course we have to keep in mind that the US markets are shut today for Labor Day, so things could go either way, right? I mean, nobody knows what to expect from the US markets. The data, the ticker hasn't been good, so the Dow is down in the red. The Nasdaq has been down for 6 straight days now. And even if you look at the data that came out, right, the US added 315,000 jobs, but the expectation was about 310,000. So it was largely in line with expectations, but not as good as what we saw in the month of July. More importantly, the unemployment rate has also risen to about 3.7%. So a lot of people are, as we said, calling it perhaps a Goldilocks scenario. Not too good, not too bad. And maybe the rate hike trajectory could continue. The last major economic report is the August CPI data that comes out on the 13th of September. That's before the FOMC meeting. So let's see how that shapes up. The big question that we're asking is this 20-day moving average, right, which is about 17,598. Is that something that the index can get back above? For now, it's below it. So just somewhere gravitating around the 20-day moving average. But give and take everything, is that a level that could be breached?
Sonia, the issue is price action is clearly indicating that our market is strong. Yeah. It has been the best performing global market last week, and ever since Jackson Hole, it has been the case. And the basic texture of the market is to buy the dip. I mean, you made more money by buying the dip than selling the rally. So that is the market's message. The 20-day moving average, I mean, I look at the exponential moving average because of the volatility. So that gives more importance to the recent price move. And in that sense, 17,445 for me becomes that line in sand on closing basis. If you're closing above that, the market's texture is still buy on dips. The US market is closed tomorrow. What that means is tomorrow morning, you don't really wake up to really bad cues. So in that sense, the last hour could really be interesting, and the bulls may just want to try their hand at long positions this afternoon. The bank nifty is very strong, and I think that is something which is really helping the market despite the pressure that's coming in from other stocks like IT, for example. Bank nifty really is the one which is helping. Now, the other point is, and we discussed this in Editors Roundtable as well, FI short positioning. The price action is not too bad, but FI somehow are adding shorts. In fact, we are almost getting to a zone in which, I mean, if you look at Friday, for example, there was unwinding of 10,000 longs and there was a build-up of 14,000 shorts. It didn't appear that in the price action. I mean, normally on days like this, the market should be down a lot. The market was not, and still there's so much, short build-up. The FI short position now, net short position on index futures now stands at 85,000 contracts, and at 81% short. The question you ask yourself is, why are these people short, and what if these shorts don't get followed through? Because shorts normally help markets if market gets a trigger to move on the positive side. Where will that trigger come from? I don't know. But the market at least is so short that any amount of, just a bit of positivity can take the market higher. This theory is out the window if the Nifty starts to close below 17,180. I mean 17,230, 240, but let's give it another 50 points, 17,180 or thereabout. But the basic impulse remains to buy the dip, at least here in India. That's my sense. But let's see if things change or not. Prashant, what do you have for us?
I mean, outperformance, right? Massive outperformance compared to very tepid, poor global cues is what we have. So I'll just start with, two figures. One is what happened last week. And this is, I mean, the Nifty as compared to the S&P 500. And then what markets have done, both markets have done since Jackson Hole. Last week, S&P was down 3.25%, Nifty was down 0.1%. Since Jackson Hole, the S&P is down 6.5%. Guess what? The Nifty is up 17 points. It's unchanged, practically unchanged. So it's just, I mean, amazing that the market here is holding on very, very strongly. The question is, if markets in the US, of course, are selling off because of two basic reasons. One is interest rate increases and quantitative tightening, which is now at a pace of $100 billion every month starting September. That's balance sheet contraction, central bank liquidity going out of the system by small bits, larger bits now starting September. Will that impact emerging markets, etc., as well at some point in time? We'll see. We'll find out. U.S. markets are closed. That's, I mean, if you're trading, that makes some difference because, as Anuj said, you don't wake up to cues one way or the other. You kind of pick up where you left off, unless, of course, something blows out in Europe, and it's possible. U.S. August jobs report avoided the most hawkish outcome. I mean, the headline number was in line with expectations, maybe even better, but average hourly earnings and the unemployment rate both ticked lower. So that provided some cushion. Markets rallied. I mean, actually, the U.S. market was up almost 1.5% immediately after. The dollar sold off, but both reversed. And the market pricing of what the Fed will do did not budge much despite this. So there is a 75 basis point hike, which is still expected from the Fed on the 21st of September. There is one more data cue to go before then and now, which is the CPI number in the US on the 13th, which is next week, not this one, the week after. So I think, that's important, and maybe that will change things around. But for now, despite what we heard and saw from the jobs report, it's still 75 basis point, which the market is expecting. Oil's, behaving at about $92, $93, but there's an OPEC Plus meeting today. Decision is expected by about, the first we will hear from them is by about 4:35 our time. If there is a cut, I think expect prices to react. It's fallen $10 on hopes that nothing comes. There is no cut. But if they decide to act like the Saudi Arabia energy ministers indicated a week and a half back, prices could move, and oil is always important for markets here. And staying on energy, the Nord Stream pipeline, which supplies natural gas from Russia to Europe, well, that's basically not coming back on stream. There was maintenance, which ended on Saturday, and, the Russian side basically saying that we need to fix certain things, and only then it'll come back on. So this is important as Europe goes into the winter season. There are those who say that the reservoirs, gas reservoirs, etc., are full, but that can last apparently 2 months worth of, utilization. But what after that if the pipeline does not come back on? So a lot of sort of anxiety and markets, of course, are reacting. The most obvious way markets reacting is that European stock futures are down quite sharply, at least that it was in the morning. And the Euro USD, it's broken parity once again. So we'll see where things go. But energy, especially in the European part of the world, very much in focus.
It's not just in Europe. You should see what's happening in the US. I was reading a report, and we'll take the story forward, actually. California, they're predicting huge energy deficits. So now they are calling for power outages, right? They're telling electric vehicle owners, they're prohibiting them from charging their vehicles because they're saying that it's going to result in a big power deficit. and a power outage. And this is the same state that about 6 months ago were encouraging people to buy EVs.
It pretty much led this entire
Yes.
EV kind of revolution, right?
Absolutely. So that's what's happening, like, not just in Europe, I mean, in the US as well. This is a story that's playing out. All right, but let's do one thing. We will talk about all this and more in the next 2.5 hours, so stay tuned. On the equities front, first up, we have Chetan Seth of Nomura, who says that they believe that hawkish central banks and concerns regarding China's growth due to its COVID strategy will likely remain a near-term headwind for Asian stocks. He adds that for now, they continue to think defensives, quality and local idiosyncratic themes such as reopening domestic demand stocks and EV renewables will likely fare relatively better in Asia. He further states that in contrast, external demand stocks like tech hardware, semiconductor memory and unprofitable expensive growth tech stocks will likely be under pressure today.
Okay, another call coming in from Christopher Wood of Jefferies. He says that recent market movements and the renewed lockdowns in China prompt greed and fear to make asset allocation changes in the Asia ex-Japan relative return portfolio. He says with the Indian overweight having almost become neutral, the allocation in India will be increased by 2 percentage points with the money raised by shaving weight in China back towards neutral. Actually, that's a very important call, whether money will move from China into India, and that's what Christopher seems to believe.
All right, let's get you some money market views as well. Kunal Sodani of Shin and Bank says that the upbeat U.S. non-farm payrolls data strengthened the dollar index. He mentions that challenges to market sentiment from energy crisis, U.S.-China tussles favor dollar bulls and that the dollar index can test 110.8 levels, not very far from there. He adds that oil prices have bounced as well with all eyes on OPEC Plus meeting due today and says the U.S. market will remain closed on Labor Day. He says that for the dollar INR, 79.55 to 79.6 to a dollar acts as a support, while 80.15 to a dollar acts as the first resistance, followed by 80.5 levels.
All right, and on the bonds, Ajay Magnolia of GM Financial says that the stability in markets from a yield and currency perspective, both these are moving in a narrow band from the last few days. He says in the absence of any fresh further cues, it's likely to move up or down based on the demand side action. He expects the 10-year benchmark bond yield to trade in a range of 7.18 to 7.25% for the day. Okay, so now we have a lot of stock-specific action to track today, so we'll get straight down to it in just a bit. In our top 10 segment, we're looking at Bharat Forge, Ramkrishna Forgings, Samvardhan Motherson, M&M Financial, BEL, Chalet Hotels, NTPC, Electra Greentech, ONGC and Oil India that are on the radar on the back of positive news flow. And guess what? There are no stocks that are likely to open in the red. Highly doubt that. But in any case, based on news flow, there's not too many negatives that we have this morning.
All right. Well, U.S. unemployment rate has hit a 6-month high, but of course, some of the details in that report have softened. Let's get you some expert opinion from Roger Ferguson, former Federal Reserve Vice Chairman, on the latest report and, of course, the rate hike trajectory, according to him.
Today's numbers were sort of straight down the middle, totally consistent with consensus, as the panel said. I wouldn't argue one way or the other in terms of this either indicating the possibility of a soft landing or not, because I think the challenge for soft landing is to actually get inflation under control. And inflation is still ranging far above the 2%. So I look at these numbers as basically consistent with what had been expected. I think the market's still pricing in a reasonably good chance of a 75 basis point move. And overall, it was sort of didn't move the markets one way or the other, which is, I think, right. But I wouldn't read a soft landing into these numbers just yet, because there's much more work to be done before we figure out whether or not the Fed gets inflation under control and avoids that bumpy land that people are worried about.
Okay, Ed Yardini is with us of Yardini Research. Ed, great to have you with us here. Thank you very much for your time. The news from the energy markets is, I think, going to be in play today. We've got the OPEC Plus meeting, and we've got this pipeline issue. So Europe pretty much left in the lurch because of this. What do you make of it in terms of the impact?
Well, I think OPEC Plus has to be careful, because if they cause energy prices to go up again too quickly, it's going to obviously depress the global economy. And the global economy has a tremendous amount of challenges. We know that the European economy is almost inevitably going to be in a severe recession related to the energy crisis. China just still seems to have a lot of problems with managing the COVID pandemic. And on top of that, they've got a housing bubble that continues to lose air. And then the United States, I think, is experiencing what I would call rolling recessions, hitting different sectors at different times. Right now, it's hitting the housing recession, so causing a housing recession. So I think OPEC Plus would be well advised to be very cautious about cutting back on supply too much and pushing prices up too high. Because as we've seen, people do respond to higher prices by cutting back.
Okay, Ed, good morning. The debate was on the jobs data, right? A lot of people called it Goldilocks. The market celebrated. Then maybe by close we found out that maybe the celebration was a bit premature. But your thoughts in general, looking at the numbers and whether that changes anything.
Not really. I mean, they were good numbers, and sometimes good news can be bad news. I think it basically was strong enough so that the Fed will, in fact, proceed with the 75 basis point hike in a few weeks at the next meeting in the FOMC. As you folks pointed out, there's still that September 13th CPI to come out. I think it's going to be a remarkably good number. I think it could be 0 or slightly negative, because we know that gas went down a lot during the month of July. We know that car prices have come down and that other prices have been moderating. If I'm wrong and we get a surprisingly high number, then I think the Fed's going to go for 100 basis points on the Fed. I think that's why the stock market did not react. Initially reacted very well to those numbers, but then on second thought, there was a recognition that, well, that's behind us now. What's ahead? And what's ahead is the Fed's commitment to bring inflation down. And as Mr. Ferguson said, the inflation rate remains way too high, way too much above 2%.
Actually, what started in March embarked on what has now become the sharpest round of rate hikes by the Fed since the 1980s, right? And I think that has caught a lot of people perhaps off guard. They wouldn't have expected the intensity of the rate hikes to be so soon and so high. So in that context, Ed, what do you do with equities as an asset class? Because since Fed Chairman Jerome Powell's speech, most U.S. markets are already down by about 8 to 9%. Do you think the worst of it is in the price, or is there more to go?
I do think we made a low in the bear market on June 16th. I know that's very controversial now that the market's back down. The bears are growling that we're going to fall below that. Maybe that they've been talking about 3,200, 3,300. I think sentiment was so awfully negative on June 16th that I think anybody who wanted to sell probably sold by then. And so I think we've kind of seen the exhaustion selling going on. I think this week will be important. I think this week we may very well make a low for this move. I think we're going to be in a range for a while, a trading range for a while. And I think the portfolio strategy is most investors who are in stocks know that they're in it for the long haul. It's very hard to trade them. It's very hard to play corrections. I mean, I've seen plenty of people who told you exactly the right point to get out of the market and then forgot to tell you about when to get back in. So by the time they told you it's okay to get back in, you're back to where kind of you started. Meanwhile, you missed some dividend payments and all that. So I think the bear market's over. I think we're going to be in a consolidation phase here. We're not going to go straight up for the stock market. But I think on a global basis, there aren't too many safe havens for investors. And the United States continues to look attractive, as we can see by the strength of the dollar. And by the way, as you mentioned before, I agree with Chris Wood that money is going to leave China and go to India, and that may continue to also support the Indian market.
Oh, yeah, that's been I mean, we've discussed that at some length here.
Sure.
Ed, just to stick to that global point, though, many believe that what Fed Chair Powell said at Jackson Hole actually is a pretty significant turning point. Some even said the reason why that was so short, he kept it to 7 or 8 minutes, is because he just wanted to say exactly what he wanted to say and did not want people to pick up other stuff and interpret it in any other way. So just, I mean, very, very focused messaging.
You're absolutely right.
Yeah, sorry, go on. I mean, so if that is significant, I mean, how can we be so sure that, the worst of this financial conditioning tightening phase is behind us?
Well, if you look at what he said in his press conference at the end of July, it was it was too much off the cuff. It was not scripted. It was not prepared remarks. It was what he responded to in a normal Q&A fashion. But the problem is that he talked so much about so many things that you could almost come with any conclusion you wanted to. And for some strange reason that I still can't fathom, the market seems to have concluded that on balance, he was saying that the Fed would start to be easier next year and that the pace of tightening would start to slow. And that's where he really felt he had miscommunicated and wanted to make it very, very clear that the Fed's number one priority is to bring inflation down. And I think you're right. I mean, that's why he kept the speech to 8 minutes. He was very specific about what he said. But when I look at the press conference and I look at what he said, in both instances, he said, if you want guidance, look at the FOMC's, the Federal Open Market Committee's guidance provided in the summary of economic projections. And that very clearly showed that the FOMC expects the Fed funds rate to be at 4% by the end of next year, or very close to 4%. And so he wanted to remind everybody that whoever got the impression that they were going to stop pretty soon and start easing next year, that was just wrong.
Just one final comment on the energy crisis that's blowing up, right? Especially in Europe. I mean, benchmark electricity prices have surged 300% this year. What are the implications that this would have on global equities, especially perhaps emerging market equities?
Well, I think you're very right about this crisis in Europe. It's of great concern. Even if they are able to get the gas for the winter, the next question is, then what? I mean, clearly you want to get through a winter season as best you can, but you also want to make sure you have energy on a longer term basis. So it's taking a while for them to line up all the alternative sources of energy. I think for the emerging markets, the main issue is the Fed, as it typically is, and the Fed is committed to tighten. It's a strong dollar, which means that their currencies are weak. Commodity prices look like they're starting to weaken. So I think, generally speaking, the emerging markets portfolio tends to be very much influenced by commodity prices, and those prices have been weaker. And of course, the strong dollar is also bad for commodity prices, and therefore bad for emerging markets. But I think the emerging markets as an asset play, now investors have to be much more picky about where they go. And I just don't think that, it's either emerging markets or developed markets. I think in this case, you don't really want to be in Europe. You want to be in the US. You don't want to be in China. You want to be in India. And the more commodity related countries like Chile and Brazil, maybe those also need to be avoided right now.
All right. Well, Ed, we leave it at that. Thanks a lot for joining in. Always good to hear some positive opinion coming through on India. So that's Ed Yardeni saying that because of the challenges that we're seeing across markets like China, Europe, money could perhaps move out of those markets and into markets like India. Let's slip into a quick break. On the other side of the break, our entire team will be with us to help us with a list of top 10 stocks. Do stay tuned in. So we begin the day today with news that the SGX Nifty is suggesting that the start for the market could be in the red. That's because most global markets were in the red. But let's see, our own markets have been resilient in a way compared to the global news flow. And there's lots more coming up through the course of September with the FOMC meeting. So let's see which way things go. Our research team is joining in to give us a list of top 10 stocks for the day. Anuj, let me begin with you. What are you looking at?
Sonia, as I said, financials have been the stronger part of the market, and in the cash market, at least, there's some FI buying. So I think HDFC and HDFC Bank, after a really long time, are starting to see some traction, and they flattered to deceive in the past. But let's see. I mean, if you look at the charts of both these names, they're taking support at the 20-day moving average, and I think that's why I'll keep an eye on both these names, because if the market has to recover, then, as I said, financials perhaps have to help. So that's why watching out for these two stocks. But you're watching out for Bharat Forge and a couple of other stocks.
Yes, those stocks could be in the green because the Class 8 truck orders of North America have doubled on a month-on-month basis. So the numbers are looking very good. In the month of August, they've come in at a 5-month high of 21,400, and this is up versus 10,600 last month in the month of July. So they've doubled. Remember, if you look at the trend, and the trend will come up for you in a bit, on a year-on-year basis, it's still down about 46%. But compared to the last several months, on an average, the sales were, the North American truck orders were about 10,000 to 15,000. And this month, it's come in at 21,400. So that's a big jump. And I think the street will definitely like that. So 3 stocks in focus. There's Bharat Forge, there is Ramkrishna Forgings, and there's Motherson Sumi as well. They have a subsidiary PKC that caters to the North American commercial vehicle market. There's also GNA Axles that has 50% of its exports that comes from the commercial vehicle market. So we'll keep an eye out on those stocks.
All right, Sonia, thanks very much for that. Mahindra and Mahindra Financial Services in focus. Abhishek has more. Abhishek, morning.
Morning, Prashant. So they have given a business update wherein they say that the disbursals are at 3,740 crore for the month of August. So this is up 75% YOY, but it's down about close to 4.5% on month-on-month basis. YTD, that is year-to-date disbursals, are at 17,150 crores, which is up 104% YOY. The collection efficiency has dipped a bit to 96% in August when compared to 97% in July. Stage 2 or overdues of more than 60 days but less than 90 days, that has improved on a month-on-month basis, while stage 3, which is the actual gross NP ratio, that remains stable in August versus July. So the company expects improvement in both stage 2 and stage 3 by the end of September. Back to you.
All right, Abhishek, thanks very much for that. So that's M&M Financial Services, very much in focus at this point in time. Let's just take a quick look at what the SGX Nifty futures are doing before we go any further. There's 30 minutes to go for the pre-open session, and I think it will be instructive to look at what's happening there. So we're down, 24 odd points, but you know, let's see. I mean, the opening itself, as compared to what the SGX has showed us last many days, has been kind of different, extended in either directions. And some of these intraday moves, forget about day-on-day moves, have been so large and so many times that I mean, if anything, up or down, expect things to remain pretty volatile, conditions being. Sonal is standing by with more stocks with news flow. Sonal, hi.
Good morning, Prashant. There are a couple of stocks on my radar today. Let me start with Chalet Hotels because the company has gone ahead. They have executed their license agreement with Delhi International Airport. So that stock remains in focus. We have NTPC, which has registered 62% growth in coal production from April to the month of August. Electra Greentech, the company has been receiving some orders, and on 2nd September, they announced that they've received letter of award for supply of 100 electric buses. Other thing which is happening in the gas markets, now Gazprom has postponed their reopening of key gas pipeline to Europe, that is Nord Stream, which was shut for maintenance for around 3 days. But now Gazprom says that it will not be reopened, and it'll be shut for times that they have not given a deadline to. And spot LNG prices, on the back of which they have surged, they are at $70 per MMBTU versus just $57, which was recorded in the month of August itself. So big surge in gas prices. A lot of stocks will be in focus on the back of that.
Okay, that's the big story, right? Both globally and locally. Thanks a lot, Sonal, for for that. But let's move on. Vahishta is tracking BEL this morning. Vahishta, over to you.
Yeah, thanks for that, Sonia. Well, Bharat Electronics has come together with Smiths Detection India to manufacture high-energy scanning systems in the country. Now, this tie-up is going to be for a period of approximately 5 years and can be extended further depending on mutual consent. Now, though defense is the mainstay for Bharat Electronics, the company has been continuously exploring opportunities in non-defense areas like homeland security and network and cyber security. Now, through this tie-up with Smiths Detection, Bharat Electronics will look at catering to the emerging market for high-energy scanning systems, which is yet another step in the direction for Atmanirbhar Bharat. Now, remember, the stock has already run up quite a bit in the past week. It was nearly at its 52-week high. We also have the management on our channel today. Let's watch out for some commentaries.
Okay, thanks a lot for that. Well, let's do a quick recap of our top stocks. Stocks with positive news flow. There's Bharat Forge, Ramkrishna Forgings, Samvardhan Motherson, M&M Financial, BEL, Chalet Hotels, NTPC, Electra Green Tech, ONGC and Oil India. While, as we said earlier, not too many stocks with negative news flow this morning. But let's do one thing. Let's take a short break. Prakash Diwan will be joining in for some stock talk. Also, Rajendra Gogri, the chairman and managing director at Aarti Industries, will be there to discuss their business outlook.
Okay, well, we have Prakash Diwan now joining us. The STX Nifty is down about 32 points. Prakash, hi, good morning. Thanks a lot for joining us. Prakash, I wanted your thoughts first on a couple of these tier 2 banks where we're starting to see a big move. City Union Bank stands out, Federal Bank. Any thoughts here, and what would be your preferred pick?
Good morning, Anuj. So, yes, we've spoken about this in the recent past where, this entire banking sector seems to be kind of getting into a little bit of a re-rating for two reasons. One is, all the bad loans issues that they had and the provisioning that was taking away a lot of the mojo from the P&Ls for some of these smaller banks with the balance sheets which are not of scale have started kind of seeing some sort of this thing come back in terms of traction. I'm quite surprised that Q1 actually, we saw some earnings where the traction on the NIM growth has been fairly decent. The volume itself of outstanding loans has grown in a very decent way. And look at how some of them would start. Also giving you the second highlight here is that this basket is something where you will see a lot of M&A getting triggered off very soon, because the government's intention to, the RBI's intention to also consolidate the sector in a way that it gets stronger players to be finally left to grow, is something which is an impulse that you always need to kind of be watchful on, positively at least. And you've seen the likes of Karur Vaishya Bank move from 40 to 70 plus in just a span of 2 months. Federal Bank, we spoke after the numbers, it's kind of started showing such trends. Catholic Syrian is also kind of coming back in terms of some of its pockets. So my sense is there is an element of growth, and all of them have found their niches where they could grow without the burden of additional NPAs getting accreted. So that's where the growth is. But the other thing that I want to highlight is that even the likes of IndusInd and some of these largish private sector banks could also start smartening up, given the way credit growth is. The M&M Financial numbers that we saw in the monthly commentary tell you that there is credit coming back into the system. And then as we get deeper into the festive season and post the monsoon, there will be a lot of activity around some of these pockets. So quite promising. My pick out there, of course, on a steady state basis remains Federal Bank, but I wouldn't be surprised if KVB continues to surprise even further in terms of a re-rating. So that re-rating is underway, but I expect it to kind of still have some legs, at least another 10-15% from here on for the short-term tactical traders. But from a long-term perspective, I would stick to a largest bank and then not add some of these smaller banks at this point.
Okay, so don't add some of the smaller banks. After the run-up, I think it's better to stick with the largest banks. Got that. Prakash, hi, good morning. I wanted your thoughts on some of these defense plays, right? I mean, look at BEL, it's up over 50% this year already. And now, apart from defense orders, they're also getting into non-defense areas, whether it's homeland security, cyber security, so broadening their horizon in that sense. Is there still more to go here?
Good morning, Sonia. Certainly, so BEL will not only be dependent on government-backed orders in the defense play, but its ability to straddle other platforms, other product lines, and then we've seen that with one of these recent announcements, the detection system that they've got into. Now, those are things which we actually have a huge headroom in terms of starting to bring under the Atmanirbhar campaign, and that's something which means there's much more openness to accept products from these kind of companies. So that's what's changed. It's not the technical prowess was missing or was not possible to bring in, but the acceptance of orders getting executed much more easily without too much of timelines getting stretched is what's changing. So I think their entire cycle, the sales cycle itself of BEL, if you notice in the two annual reports from 2021 and 22, it's so distinctly different. The commentary is so different that you can make out that things are moving much faster. And as they get into slightly more complex projects, Sonia, the milestone payment system, which let's say a garden shipbuilder does, that's the kind of eventuality which will happen to some of these larger critical suppliers on defense as well. So non-defense is, of course, an optionality. The defense play itself gets deeper and wider. So I don't see any reason. But, the stocks run up so much that you at times wonder whether you're too late to join in, right? So, I mean, if the market gives you a dip, probably, these are things that you want to add on without much of worry in terms of what happens to the global markets.
Okay. We actually, we're going to talk about the specialty chemical space in a bit. We have the management of Aarti Industries joining in. 84% of their revenues comes from specialty chemicals. But before we do that, Prakash, you just want to set the context here from an investor standpoint. How are you looking at many of these companies in the, in the situation where raw material prices are extremely volatile? Most of it is passed through for these companies, but in any case, they've been struggling a bit. Your view here?
So, chemicals and specialty chemicals within that is getting to be a very clear two-segment play. One is, companies that have a lot of dependence in terms of absorption or exports to the European Union. They are the ones that will probably struggle because there's this sudden crash in demand. If you talk to dealers within the chemical space, you'll be surprised to hear that there's nothing in terms of an offtake for the last couple of months, and there doesn't seem to be any change happening there, because if they have shortage of basic stuff like fuel and gas and all, there's no way they can use specialty chemicals to process that, right? To come up with their end product. So that's a pocket that you need to stay out of very clearly. The other pocket is the import substitution, which is booming. I mean, you have so many companies that are the only ones making this and filling the gap, which is happening because there's no imports coming up. So things like ammonia, potash, all these have started kind of taking such a different use of chemicals that go into that value chain. Caustic soda, soda ash. So there's a lot that's happening globally from the supply chain reset, and that's where the pocket just gets interesting. And of course, the companies like Aarti, which are so well integrated, will tend to be much more insulated and always deserve a premium. But I wouldn't be surprised the way SRF after its numbers looked a bit tepid, but it's kind of bounced back. It's going to be a fair amount of traction that will continue here. It's not yet over. The China Plus is just getting to be China Plus and Europe Plus. So things are different and very positive for the specialty chemical play.
Okay, positive on the specialty chemical play. In fact, let's take that discussion forward, right? Aarti Industries is in focus after their annual report highlights growth prospects which are likely to be supported by expansion projects as well as increased utilization and a strong product pipeline. The company aims to add over 40 products in the chemical segment and around 50 in the pharma segment by FY 24-25. Rajendra Gogri, who's the chairman and managing director at Aarti Industries, joins us now to talk about that. Mr. Gogri, thanks a lot for joining in. I want to first ask you about the volatility that we've seen in raw material prices. I do understand that you have a pass-through model, but in general, what is the EBITDA per kg because of the volatility that we've seen? And how often are the long-term contracts up for price revision? Mr. Gogri, we can't hear you. I think you're on mute.
Yeah, sorry.
Yeah, go ahead.
In export, generally, we have a quarterly lag. So every quarter, we reset the prices based on the previous quarter raw material. Whereas in domestic, it is a month-to-month pass on. But now the commodity prices have started easing in. The benzene, which was more than 110, has reached below 80. So that is kind of helps in working capital for us.
Mr. Gogri, hi, good morning. You'd earlier said that in Q1, about a quarter of the revenue increase that you saw came from raw material pricing, price increases, etc. Could you tell us, have you had to take more price increases in this quarter in Q2?
Q2, the July was the peak. Now in September, the prices in last 2 months of the raw materials have corrected. So overall, I think raw material prices may remain equal to Q1 on an average basis for you.
What about volume, sir, for you in Q2 so far?
Yeah, it will be of a similar on an average, I think.
Some of the production was impacted for you, right, a few quarters ago because of the shortage of nitric acid, which is a key raw material. Has that situation improved now? And you had said that you would set up a capacity of around 100 crores. When would that get commissioned?
Yeah, nitric acid situation has improved a bit, and the plant which we are thinking of putting up is a concentration plant, and which will be commissioned in FY 24, toward the end of FY
24. Towards the end of FY 24. Okay.
Yeah.
Got it. Sir, are there any execution delays broadly? I mean, you had said a couple of quarters ago that, you'd announced capex of some 3,000 crores over 23 and 24. This was almost, 3-4 quarters ago. Has construction started? Could you give us some details? And generally, are there delays that you're facing?
Yeah, our ongoing projects, everything are on track. Our greenfield expansion with new products, that construction will start from second half of this year. And FY 24, first half, I think most of the process blocks will go under construction. So overall, our 4,500 to 5,000 crore guidance for the 3 years. We are quite well on track.
Okay. There is a trend that's playing out because of higher gas prices globally. A lot of companies are facing a hit. It's impacting production globally as well. Could this mean more opportunities for domestic players, and will that in any way change the construct of the industry?
Yeah, especially European players are impacted, and the basic chemicals in Europe, we see that some sort of impact happening, but on a finished products, then of course they are value-added products. In general, that will not be impacted. So players like Indian companies will definitely get benefit because of that.
No slowdown in orders though from Europe and Germany, etc., because of what is going on?
Yeah, there is not much overall, not much impact on orders.
So if this does mean more business for players like yours, the fact that, higher gas prices globally is hitting production and production moves away from China and perhaps into markets like India, what kind of growth do you see for the industry and for yourself? Because FY22 was a pretty strong year. You saw a revenue growth of over 40%. What do you see as the growth in FY23 and 24?
Yeah, FY23, we had guided about 15% top line and about 10% EBITDA. The next year is going to be really good for growth in EBITDA, as we see substantial portion of gross profit translating to EBITDA growth. So FY24, another about 30% growth over FY23 in EBITDA, what we are looking for.
Mr. Gogri, your longer term guidance is for revenues and profits to go up, to double between 24 and 27. Is that, does that look to be on track?
Yeah, and overall with full ramp up of existing products and projects and the new projects, by FY27, we see that, what guidance we had given to about 3 to 4 times on profitability over FY21 should definitely be possible.
3 to 4 times in 27 from 20 compared to 21 figures.
Yes, yes.
Okay. Any update on the demerger of the pharma business?
Yeah, most probably we should be able to complete the formality in month of September.
Okay. So everything will be done. The demerged entity will come through by September, is it?
Yeah, I think in September we should be able to finish the formality. Then listing and all may take whatever, maybe another couple of months.
Okay, another couple of months for listing. All right. We'll leave it at that, sir. Thanks a lot for joining in and giving us an update. I think Prakash Diwan is still with us, so if you can just get a comment from him on that. Prakash, they're demerging the pharma business. They will list it as well. And very strong. I mean, they're expecting 15% revenue growth in FY23 itself. Any thoughts?
So, yeah, I mean, this is a logical extension of whatever they've been doing in terms of the new expansion, greenfield as well as brownfield, Sonia. But, if you look at some of the comparable businesses which have done much more and probably earlier in the life sciences area, there's one company that comes to my mind, got listed sometime, I think last year, did very well, and then it's been lying low. It's called Ami Organics. It's not a recommendation, but I'm just trying to draw parallel how these things work. The pharma, the life sciences vertical is something which is much more complex because the client base certainly kind of has a very different set of expectations. Of course, Aarti has its credentials to definitely stand up to those expectations well. That's not an issue, but I would want to see that happen. The demerger is something which is much more of a activity that has more challenges post it rather than before it. So once that is done, then you'll probably be able to do it. But otherwise, it's a great company. There's been no complaints in terms of what investors have got out of it. But as I said, specialty chemicals have seen a run up. While things look very positive, everything's good at a price, and you would probably want and wait for that level to come for things to become much more promising from a investing perspective. While the business remains very promising for sure.
Okay. Prakash, stay with us. We need to take a break. We'll come back and discuss market technicals with Sudarshan Sukhani and Mitesh Thakkar. Welcome back. Well, the S6 Nifty is cutting its losses. Actually, it's not too much of a loss. I mean, 25 points really hardly classifies as a loss. We have Sudarshan Sukhani and Mitesh Thakkar now joining us. Gentlemen, good morning. Now, both of you have been in agreement that this is a market in which you are broadly positive and want to look for buying opportunities. The entry points might be different. But Sudarshan, what's your approach now incrementally? Both in the Nifty and the Bank Nifty.
Yeah, good morning, Anuj. For the last 2 days, that is Thursday and Friday, the Nifty has been in a very narrow range. In fact, on Friday, it was extremely narrow. Now, usually these narrow ranges are precursors to a breakout on the upside or the downside, depending on the market mood at that time. So I would expect a reasonably big move to come in. Now, because the Nifty maintains its support levels, I'm not looking to go short. The trade for me is if the Nifty holds 17,450 for the day during the morning, then I would look to go long. I'll keep it intraday because I think the US markets are closed. There's no sense in carrying a position. But the trade is if this support level holds, go long for the day. I'm not looking for any short side trade today. The same applies to the Bank Nifty. If the Nifty levels hold, go long in the Bank Nifty also. Intraday only.
Okay, fair point. So intraday long 17,450 is the stop loss. No shorts on the Bank Nifty. Also same trade. I mean, of course, you put a corresponding stop loss. That's what Sudarshan is saying. Intraday only, no position long because you don't want to take a risk with the US market close. That's Sudarshan's view. Mitesh, good morning. Your approach on Nifty and Bank Nifty, you have been constructive on the market.
Morning, Anuj. This looks like a market, which basically is still contracting, as Sudarshan was also highlighting, and I've been maintaining that view for last many days now. Broadly doing a range of about 17,400 on the downside to about 17,750, 800 on the upside. And I think that remains. We don't have any signal of volatility rising or any expansion coming in via the way indicators are positioned. Having said that, I think, therefore there's a stronger chance that this consolidation will keep on or remain in force. And I think, only once we get a signal, then I think we'll be extremely positive or aggressive on the directional view of the market. So for the timing, I think it's a wait and watch kind of a thing for me on the indices. And till I think, a constructive signal comes in, I think it makes sense to just stay put. Of course, if you get towards the lower end of the range, which is close to about 17,400, 420 odd zone, then I think you might want to take a long bet or long position.
Okay. What about individual stocks? Sudarshan, good morning. What are you looking at today, both on the buy and the sell side?
Good morning. Because of the narrow range, stock options have also, the opportunities have also become restricted. But Hdfc Amc is an intraday short. The stock has been falling for the last 10 days and relative strength is now weak. Momentum is coming down. Keep a stop of 2050 and look for an intraday short. Persistent Technologies is another same chart. For the last 10 days, it's falling day after day. It's an intraday short with a stop of 3442. Tata Communications is a buy. It broke out. It's at 3-month highs. On Friday, it had a small dip. A down day, I would treat that as a dip. Buy it with a stop at 1200. And UBL, which is now on the verge of making 3-month highs. It's been rising for the last 3-4 days. Hopefully today would be a dip. That's a buy with a stop under 1660.
And what about you, Mitesh?
Yeah. So I also have mix of buys and sells, 2 buys and 2 sell calls. On the buying side is Tata Consumer. On a mild dip, let's say around 828, 827, buy with a stop below 817 for targets of 850. UBL is a buy with a stop below 1680 for targets of 1760, while Aurobindo Pharma features on the sell side of the trades. Sell with a stop at 542 for targets of 518. And Bandhan Bank is a sell. It's a conditional sell. I would want to see it trade below Friday's low. So sell below 274. Keep a stop at 278.5. Look for 262 as the first target.
All right, gentlemen, thanks a lot for those trading ideas. So UBL is something which is common in both Mitesh and Sudarshan's picks. That's been doing well, actually. We'll take a short break. Up next, of course, we have the pre-opening rates and Amit Dixit of Edelweiss will be joining us to focus on the metal space.